Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So in this video, as always, I'm going to share with you guys 5 companies that are undervalued that you could potentially be doing a little bit more research on for the month of May. This is a series that we've been doing for quite some time, and inshallah we're going to continue doing this. All 5 companies have a wide moat. All of them seem undervalued at this point in time. Some of them are reporting next week, so we might even see an opportunity to even buy basically cheaper than today's price. And I wouldn't be surprised the way things are going with the stock market right now. A lot of companies have reported last week. It was up and down, so we might even see another dip next week. We might see another pullback. Overall, whatever the situation is, as always, we are long-term investors. We are not worried about the fluctuation of prices for the next week or month or whatever. We want to buy high quality businesses, and that's what I'm trying to do here, is just build a portfolio of high quality businesses that will inshallah at some point give us enough passive income so we can retire and so on, right? That's the goal. And right now, when things go down, that's the time we actually say, okay, let's do a little bit more research and find high quality businesses that are discounted right now. And that's exactly what I'm going to do today with you guys. I'm going to share some information. As always, of course, do you research a bit more than what I'm giving you right now, because I'm just kind of giving you an overview of what these companies do and so on, and the fact that I think is undervalued and so on. So just make sure you do a little bit more research, inshallah. If you haven't liked the video already, please do so. It really helps the channel. Let's get into the 5 video companies that we're here for. I want to make the video as short as possible. And the first one that we're looking at today is Lam Research. This is a semiconductor company. It has come down quite a bit. So if we look at, for example, for 1 year, it's down about 21%. A year to date is down just 1%. It's actually not bad at all. But for the last 6 months, it's down about 8%. So it is down quite a bit right now as we speak from the all-time highs. In fact, let's just look at the all-time highs for this company. It was $113 per share, and right now it's about 71. The lowest it's been is about $56 per share. And as you can see here, according to Morningstar, it's actually 20% upside. It has a 20% upside from where we are. It has a nice dividend of 1.3%. The payout ratio is only 24%, which means it is quite good in terms of like they can increase that and a lot more, because they're spending basically 24% of their net income to pay us these dividends. Latest increase was 15%. The 5-year growth rate of double digits, 13%, and they have increased it for 10 years, which is quite nice. 66% is the dividend safety. 61 and above is safe. Profit margin, return on equity, return investor capital, probably one of the best out there. Excellent free cash flow of almost $4 billion. They expected the earnings to grow about 31%. Revenue is expected to grow about 22%. But just to show you how cyclical these companies are, and we've always said semiconductors are quite cyclical businesses. Although they expect in June of 2025, that's when they finish the reporting, right? Basically after that, they're expecting the earnings to decline, to basically go to almost 1%, and then to bounce back in 2027 about 16%, 18%, 7%. And so that's the thing that you really need to be careful, because some of these companies, they might actually look good right now. And then what I'm reporting here is basically for the year ending June 2024. So basically a couple of next quarter, basically this company will end that. So quickly to show you using basically a fast graph, basically what we think about the company. As you can see here, when on max, so since 2005, as you can see, it looks like it's undervalued, because when this line, the black line here on the top here, is basically lower than the orange line, then that means the stock is potentially undervalued. And that blue line is what the normal PE has been for this company, what Mr. Market basically likes to value this company. And as you can see, it's actually under that orange line. If we reduce that to 10 years, it's slightly higher than that, and if we reduce it to 5 years, it's slightly even higher than that. But the important part for us is, they are just in earnings growth rate expectations, and also looking at the forecast, because that's how we value stocks. We want to see what the company will do in the future. So if we look at for example, the forecast for this company using the normal basically PU about 15, basically right now we will be making 1% every year for the next basically 2 years if we were to buy this stock at this price. But if we were to buy the stock at where it is the current PE, if we use the normal PE, the normal multiple that the market likes to value this company, right? It's actually basically you will be making about 12%. That's basically that's the total return for annualized total return year after year. And so, which is absolutely fine. Again, so you need to make that decision for yourself and say, okay, am I going to buy this stock at basically a PE, normal PE of 15, the fair value for 15, or am I happy to actually buy in slightly higher, about 18, almost about 19 PE? So that's a decision as you need to make as an investor. But in my opinion, it is undervalued right now. And then if they report in the next couple, I'm not sure when they're reporting next, but if they do report and it goes down, then of course that might give us an opportunity. And the next one is ADP, which is basically a company that's reporting. Just quickly show you actually some of the companies that are reporting. ADP is one of those, automatic data processing is one of the companies I do own in this portfolio that is reporting. And we also have companies like Waste Management, Visa, MasterCard that's reporting next week. So some of the oil big boys in the oil industry. So yeah, there's quite a few companies reporting. So we will see the Microsoft, the Metas, and Qualcomm is another one. So yeah, it will be interesting earnings to see. But ADP is reporting. It looks like it's right now basically fair valued. It's not basically undervalued as we speak. So we might get a chance next week if it is basically goes down. And as you can see, they're expecting the earnings to grow about 8% and the revenue to grow about 6% overall. And of course, this is probably one of the best dividend paying companies out there. And as you can see, they have increased that dividend so for 50 years, which means they are a dividend king. Historically, this company has always been overvalued according to basically fast graph, and as you can see here, this is the orange line. That is where the price, the Mr. Market, basically likes to value this stock. And the best time to have bought this company was around there. And if you sold it when it went as high as whatever was it $315 per share, you would have made about 16% annualized rate of return, which would have been absolutely amazing since 2005. If we reduce that to 10 years, okay, it still seems undervalued. If we even reduce that to 5 years, it still basically seems overvalued. Now if we look at the forecast moving forward, because again that's the most important thing, because we want to see how much we're going to make in terms of adjusted operating earnings growth rate of about 9%. The PE, normal PE, this company is for 15. Basically we would be losing about 17% right now if you bought it. If you use a normal multiple, the normal multiple for this company that has been trading, which is about 28, you would be making about 8%. Again, that's the decision that you need to make. But based on this right now, it seems basically it's fairly valued. Based on to fast graph, if you use normal PE and you think it's going to trade around that PE, normal PE, then of course it will be undervalued. Okay, the next one is one that I'm not going to spend a lot of time because we've talked about this company a lot. Taiwan Semiconductor. It seems very much undervalued at the moment. The growth expectation for this company is absolutely huge. It's so much undervalued, 65% undervalued right now. If we go to fast graphs, if we type TSM, let's see what fast graph has actually basically says about this company. If we click max, as you can see, basically it seems overvalued right now as we speak. But based on the max, for example, if we do the reduced after last 10 years, it's also still over that orange line, but below that what the market has been trading this company. Again, more or less the same as well. And we can see about for the last 5 years with basically massive growth of about 14% when it comes to adjusted operating earnings growth rate sort of thing. The forecasting for moving forward for this company, as you can see here, we've got about 20 and 20 PE. So that if we bought it right now based on this valuation, we'll be making about 18% total annualized rate of return, which is absolutely amazing. If we also look at what Mr. Market has been saying about the company, is more or less the same, because that's the about 29%, almost to 30%, which is really good. Right, but yeah, another company that is so much undervalued. The next one is Gilead Sciences, and this is a pharmaceutical company. It's been around for a very long time. They pay excellent dividend of over basically 3%, the 40% payout ratio. The latest increase was only 4%, the 5-year growth rate about 4%. Normally we're looking for over 6%, but this is okay. 9 years basically of increasing that dividend. 70% safety, profit margin, return equity, return investor capital is probably one of the best. One of the reasons I've included this company is the fact that they have excellent free cash flow, and the EPS is expected to grow about 72%. Remember, again, pharmaceutical companies can become a little bit at times cyclical, because if they have a patent on a thing and the stock can go up for quite some time, and then as long as the patent is around, the company will tend to do well, but once the patent is over, then it start losing basically market share to other companies and so on, and the EPS probably will shrink, but revenue side of things as well. The EPS right now is about 72, because revenue is expected to decline about, I think, was a 0.3% basically percent, which is not good at all. Morningstar is saying it's about 5% undervalued at the moment. $108 per share is where they think the price should be. Now, if we go to Fast Track, for example, and look at this company, because we and look at the historically how the company has traded in terms of valuation side of things, you can see it's a very cyclical business, and it looks like about 17% adjusted operating earnings growth rate for the last basically since 2005. Basically, if we look at the last 10 years, you can see it's basically seems very much overvalued. If you look at the last 5 years, it's slightly better, but it still seems overvalued. Now, when we look at the forecast, this is when the company becomes interesting, because we got basically adjusted operating earnings growth rate of about almost 20%. Now, if that happens, okay, and again, no one knows whether that's going to happen for the next. This is remember the forecast. The forecast for this 2025 is about 72%, which we have seen 73%. Then 2026 we're expecting about 8%. 2027 we're expecting about 6.44%. And there's a lot of analysts looking at this, so there's not short of analysts looking at this company. So 25% total annualized rate of return, which is absolutely amazing. And if you look at the normal PE for the company, more or less basically the same. Basically it's about 2%, which is absolutely ridiculous. But the estimates based, if we use just normal estimates based on the operating adjusted operating earnings, we are expecting this company will grow about 25%, which is really good. Okay, 25% is like massive growth, isn't it? So the next one, close this thing. The next company is one I'm really excited about, because S&P Global is one of the companies I own in my portfolio. It's been in the portfolio quite some time. Very, very high, like in the high quality business in my opinion. They have an excellent dividend. They've been growing that dividend over 51 years, so the dividend kings. The 5-year growth rate of 10%. Profit margin return on equity is absolutely fine. Return on invested capital is about 9%, which is a little bit disappointing, but it could be better. Free cash flow is really good. They're expecting the earnings to grow about basically 8%, revenue about 5%. The Morningstar is saying right now it's about 13% upside from where we are. $520 per share is basically where they think the price should be, and right now we're looking at about $480. Now, looking at the fast graph, you would think straight away, of course, the company is overvalued. We've got adjusted operating earnings growth rate of about 11%. Fair valued for the last 10 years is basically 15 multiple. 25% has been the normal for what the market has like to trade this company. If we reduce that to 10 years, it still seems overvalued. 5 years is still basically overvalued. But when we look at the forecast, for example, if we're using that 15 PE, we actually will be losing about basically 12% or so on. But when we use the normal PE for this company, that's basically, which is about 31, okay, multiple, that's basically where the company becomes slightly undervalued. And the total annualized rate of return you will be making is about 8%, including that 0.8% dividend yield. So if you invested $10,000 in this company, basically by the time we get to 2027, you will have 14,000 pounds, 14,000 basically US dollars, which is basically about 41% up and higher than what you've invested. So again, it's really great company, and I think if we see a pullback in the overall market and you can get this one below, I think 450ish, then I think this will be absolutely amazing. I think I would like another 5 to 10% drop for me to start looking at it. I'll show you exactly how many shares. The two that I own in this portfolio is these two here. I'll show you exactly how many shares of these two I own right now. And the first one is ADP, and as you can see here, I've got over £5,500 invested of 25 shares. I'm up about 17%, or just over basically £100. And as you can see here, $233 per share is my basically average right now, or £187. And right now it's basically $292. I wouldn't be buying right now, I'll be honest with you. If there is a massive pullback in the overall market, I will potentially do it, but I will definitely wait for a bit. The other one is basically trading currently $482 per share. I've got about 16 shares, up 25%, £1,184. And my average right now, as you can see, here is $350 per share, and right now is for basically $480. So I wouldn't buy I wouldn't mind buying the fact basically another 4 shares or so, but like I said, I need to see a massive pullback overall. But again, it's starting in new basically. If you have not invested in the company, potentially you can start nibbling a little bit here and there whenever basically you get a chance. And this is the Sharia compliance side of things from Zoya Sharia basically compliance side of things, which basically uses these standards. You can Google it, you can find out more information if you need to. I'm going to stop the video here. If you haven't liked the video, please do so, because it makes a massive difference. And yeah, join us if you can on the Patreon account. Have a wonderful day. Assalamu Alaikum.